Welcome back to the COO's office. We are building a portfolio for you, Inc., step by step. First, we looked at the map with top-down and bottom-up analysis. Second, we checked the engine by reading the financial statements. Third, we checked the price tag using per PBR and ROE. By now, you might have found a company that is profitable, healthy, and cheap. You are ready to buy. But there is one final danger. A danger that kills more businesses than debt or bad management. That danger is competition. In a capitalist society, profit is like blood in the water. It attracts sharks. If you open a lemonade stand and you are making a fortune, what happens next week? Your neighbor opens a lemonade stand right next to you, and he sells his lemonade for 50 cents less. Suddenly, your profits disappear. Your customers leave. This is the brutality of capitalism. To survive, you need protection. You need a defense system that prevents the neighbor from stealing your customers. In the medieval ages, a king would build a castle. But a stone wall was not enough. To stop the enemy from even reaching the wall, he would dig a deep, wide ditch around the castle and fill it with water and crocodiles. This is called a moat. In investing, we look for the exact same thing. We call it an economic moat. Today, we are going to discuss how to find companies that are impossible to kill. We will learn how to identify an economic moat. This concept was popularized by Warren Buffett. He said, "I look for economic castles protected by unbreachable moats." If a company has a wide moat, it can survive for decades. It can raise prices and customers will stay. It can make mistakes and still make money. If a company has no moat, it is just a commodity. It has to fight a price war every single day. So, how does the coup identify a moat? What are the bricks that build this defense? There are 4 main types of economic moats. Moat number 1, intangible assets. These are things you cannot touch but are worth billions. The most common one is a brand. Think about Coca-Cola. You can put brown sugar water in a bottle and sell it for cheaper than Coke. But people won't buy it. They want the red can. They trust the taste. They buy the feeling. Because of this brand, Coca-Cola can raise its prices every year and people still buy it. That is a moat. Patents are another intangible asset. If a pharmaceutical company has a patent on a cancer drug, no one else is allowed to sell it for 20 years. That is a legal monopoly. That is a wide moat. Moat number 2, switching costs. This is when it is too painful, too expensive, or too annoying for a customer to leave you. Think about the software ecosystem. Think about Apple. If you have an iPhone, an iPad, a Mac, and an Apple Watch, switching to Android is a nightmare. You lose your photos, your apps, your messages. It is too much of a hassle, so you stay. Think about enterprise software like Microsoft Office or Oracle. Once a company trains 10,000 employees on Excel, they are not going to switch to a cheaper competitor. The cost of retraining everyone is too high. High switching costs trap the customer. It sounds aggressive, but for an investor, it is beautiful. Moat number 3, the network effect. This is the most powerful moat in the digital age. The network effect happens when a service becomes more valuable as more people use it. Think about Facebook or Instagram. Why don't you switch to a new social media app? Because your friends aren't there. The value of the network is the people. Think about Visa and MasterCard. Merchants accept them because everyone has a card. People carry the card because every merchant accepts it. It is a virtuous cycle that is almost impossible for a new competitor to break. Moat number 4, cost advantage. This is the ability to provide a good or service at a lower cost than anyone else. Think about Costco or Amazon. They are so huge that they can demand the lowest prices from suppliers. They have the most efficient logistics network. If you try to compete with Costco on price, you will go bankrupt. They can survive on razor-thin margins because their volume is massive. Their size is their moat. So, we have 4 types of moats: brand, switching costs, network effects, and cost advantage. But how do you know if a specific company actually has one? The coup has a simple test. It is called the pricing power test. Ask yourself this question. If this company raised its prices by 10% tomorrow, would its customers leave? If the answer is yes, they would leave immediately. Then the company has no moat. It is competing on price. It is vulnerable. If the answer is no, they would grumble but stay. Then the company has a wide moat. If Apple raises the price of the iPhone by $100, people still buy it. If a generic gas station raises the price of gas by 10 cents, people drive across the street to the cheaper station. Apple has a moat. The gas station does not. However, a word of warning. Moats are not permanent. The water can dry up. The castle can crumble. Kodak had a massive brand moat. But technology changed and the moat disappeared. Nokia had a massive scale moat, but the smartphone disrupted them. The coup must always be vigilant. You must ask, is the moat getting wider or is it getting narrower? We want to invest in companies where the moat is getting wider every year. So, your assignment is to look at your target company again. Don't just look at the numbers. Look at the castle. What protects it? Why can't a competitor destroy it? If you can't identify the moat, you are just buying a castle made of sand, and the tide is coming in. Now, let's assume you have found a perfect castle. It has a deep moat. It has gold in the vault. But even the strongest castle exists within a kingdom. And sometimes, the weather in the kingdom changes. Sometimes, a storm comes that affects every castle, no matter how strong it is. In the financial world, this weather is the macroeconomy. It is the invisible force of interest rates and exchange rates. In the next episode, we are going to look up at the clouds. We will discuss macro indicators and their relationship with stocks. We will learn why the stock market crashes when interest rates go up and how the value of the dollar affects your portfolio. Find your moat, protect your castle. I'll see you in the next video.